This presentation is on the principles of option pricing. My name is Pat Obi, Professor of Finance at Purdue University, Calumet. We begin with a review of call option pricing, and we show here the 5 key variables impacting the value of the call option. They are the price of the underlying assets, which could be a stock, the expiration time of the option T, the exercise or strike price of the option E, the volatility of the stock sigma. Now, by the way, volatility here again refers to the volatility of the price of the underlying asset during the term of the option. And then finally, the risk-free interest rate R. And then on this side, we show the nature of the relationship between each of these variables and the price of a call. For example, we show here that there is a positive relationship between the price of the underlying asset and the price of a call. For example, if the underlying asset is currently priced at S equal $22 and the call option's exercise price is 20 and the call premium is 3, then we show that the intrinsic value of this call option, which is S minus E, would be equal to 2. So now suppose that the stock rises in price to, let's say, 25 as I indicate here. What that means is that the new intrinsic value would be 25 minus 20, which would give us an intrinsic value of 5. And so as you can see, as stock price rises, so does the intrinsic value, meaning that the call option is worth more as the stock rises in price. The next variable here, expiration time, also has a positive impact on the value of a call, in that the longer the time to expiration of an option, the more valuable an option is, all things equal. And what this simply means is if you have two options, one that expires 1 month from today and the other expires 1 year from today, if all other factors are the same, you would value the option that expires a year from today more so because you do have a full year to hope and speculate and wager on a profitable price outcome. So if you have a longer time to play, then the option is more profitable. The third variable here, exercise price, obviously is going to have a negative impact on the value of a call, because as you see here, as the exercise price rises, the intrinsic value of the option would go down. So if this exercise price were to go up to, let's say, from 20 to 25, then the intrinsic value, which would be 22 minus 25, would be 0. Remember, transactionally, because an option gives you the right, not an obligation, if it is out of the money in that the intrinsic value would otherwise be negative, then you would not exercise the option. You would simply let the option expire, in which case truly the intrinsic value of the option becomes 0. Volatility requires a little careful assessment here, because in investments and actually in every other aspect of finance, volatility is a measure of risk, and as volatility rises, so does the cost associated with an investment. So the cost of capital would always reflect increased risk, because as risk rises, you would value the investment less, the underlying investment, that is. Now though, in the case of an option, volatility is actually a variable that positively impacts the price of a call. And the reason is simple: the more volatile a stock is, the more valuable the call would be, because volatility means that the price can shoot up or shoot down in very significant ways. A call, of course, would offer you an increased benefit of expiring in the money if the price of the stock jumps right up significantly, because again, as you can see up here, if this stock price were to suddenly move up to, let's say, $40 per share, then the intrinsic value would be 40 minus 20, which is the exercise price, to give you an intrinsic value of 20. And again, as volatility causes the stock to surge in price, you would continue to find that the intrinsic value would rise more and more, which is a gainful outcome here. Now you might say, well, but volatility also means that the price of the stock can shoot way down. And you are right, except of course if it were to shoot way down, let's say from 22 it shoots way down to a value of 5. What do you really care? Because the most you can lose in this call transaction is the call premium you paid. Remember, you cannot lose more than the price you paid to buy an option. And so because volatility offers you an opportunity for a highly profitable outcome if price moves sharply in the direction that you seek. In the case of a call, it would be in the upside direction. It is considered a very important and profitable parameter, and one that has a positive relationship with a call option. And finally, we're going to show in an intuitive manner that there is also a positive relationship between interest rates and call prices. So here we show that because an option cannot have a negative value, therefore the minimum value of a call option would be no less than 0. That's what this is saying. It says that a call defined over the base variables of the current stock price, time to expiration, and exercise price, that its value has to be at least equal to 0. It is 0 if the option is out of the money and greater than 0 if it is in the money. Now remember, there are two key types of options, an American option and a European option. An American option can be exercised at any time prior to maturity, while a European option can only be exercised at maturity. Now these two features in the exercise of an option causes us to evaluate them somewhat differently in certain respects, and this is one of those. Now, for example, we can speak of the minimum value of an American option, which really is the same as the option's intrinsic value. And we show here again that the minimum value would be the greater of 0 if the option is out of the money, or S minus E if the option is in the money, and therefore an option's value cannot be less than 0. So I show some numeric example here where currently the stock is selling for $15, exercise price is 10, and we find the intrinsic value of this option, which is S minus E, to be 15 minus 10, and that gives us 5. And so the intrinsic value of this option is 5, meaning that if you are a holder of this option, you can choose to exercise it now, and your instant gain would be 5 prior to subtracting the cost of the option itself, which is the premium. So think about this. Suppose that this option's premium at this very time is equal to 3. Now if the option sells for $3 per share, then it would have violated this minimum value condition here, because 3 is less than the intrinsic value of 5, which is S minus E. Now if this were to happen, then what you should do rather quickly would be to buy this option right away, paying only $3, and then you turn around and exercise it right away. And of course you see here, by exercising you will get $5, and $5 which you get upon exercise minus the 3 you pay to purchase it still leaves you with a sweet little money of $2 a pop. And so you would want to buy this option, and so also would a lot of people want to buy it. And as the demand for this option increases, so will its price until it hits a value not to be less than 5. We note here though that this minimum value condition does not hold true for a European call, because a European option can only be exercised at maturity, or if you like, cannot be exercised prior to maturity. They mean the same thing. Now continuing, we also show here that the maximum value of a call option has to be the stock price, and the reason is simple. Remember, a call option gives you the right to buy the stock itself. So surely you wouldn't want to pay an amount to buy the right to eventually buy that stock, an amount that exceeds the price of the stock itself. It really wouldn't make sense, right? Now, if a stock is worth $50, you wouldn't want to buy an option that costs more than 50, since if you were to exercise it, the stock would have a value of no more than the $50 at which it is currently selling in the market. At expiration, however, note here that an option would be equal to the greater of 0 or the intrinsic value at expiration. Now this, by the way, this mathematical representation here, which is max, and you open parenthesis and you write 0 comma, and then this argument simply means the greater of 0 or this argument here, the difference between the stock price and the exercise price. So now I note here that at expiration a call is worth its intrinsic value, no more, no less. Remember, at expiration there is no more time value. And so if a stock is worth 15 and the exercise price is 10 and the intrinsic value as shown here is 5, you wouldn't want to pay less or more than 5. Nobody would. Well, say for example this stock is selling, the option is actually selling for $4 per share. At expiration, with no time value left, you would of course want to buy this option right away. You scoop it up and then you exercise the call right away. Again, you make 5 minus the 4 you paid, you smile to the bank with $1. Now if on the other hand this option is selling for $6 per share, what you should do instead is to sell the call, because 6 is greater than 5. Now let the notion that guides your understanding of an arbitrage argument be the age-old saying that you should buy low and sell high. So in the case where the call is selling low at 4, which is because it's less than 5, see, you bought it, and by buying it and exercising the option, making 5 minus the price you paid to buy the call, you enjoyed an arbitrage profit of $1. Now if on the other hand, as I was saying, the call is actually selling for 6, which is higher than 5, so you're going to have to sell high. So you sell it, receiving $6, and the person who purchases it from you would have to exercise it right away because the option is expiring. So by the person exercising it, you will lose, the option writer would lose $5 because it is the intrinsic value. But the $5 you lose, net of the 6 you received from selling the option a quick second ago, leaves you with an arbitrage gain of $1. And so either way, at expiration you will find that rational investors wouldn't want to price an option for more than its intrinsic value. And so here we conclude by saying, in terms of the effects of exercise price and time to expiration, that for the exercise price, if two options differ only in terms of their exercise prices, in the sense that here E2 is a value greater than E1, then you will find that the option with E1, meaning the option with the lower exercise price, cannot sell for less than the price of the call option with an exercise price of E2. So under all but exceptional situations, the call with E1 would sell at a higher price, again because E1, which is lower than E2, would offer you a greater intrinsic value. See, if E1 here is 5, 15 minus 5 gives you an intrinsic value of 10. And if E2 is, let's say, as this is 10, then S minus E would give you a smaller intrinsic value of 5. And I did mention about time to expiration before, in the case that the option with the longer time to expiration would be more valuable, or in the case of this argument be at least as valuable as the option with the lower expiration time. And again, because a longer expiration time gives you more room, more wiggle room, more time to hope for a much more gainful outcome in this transaction. Now finally, I did indicate a note here about time to expiration concerning two types of options, a deep in the money option and a deep out of the money option. So here's what's up. It says that the time value of a call varies with respect to time to expiration, of course. The longer the time to expiration, the more valuable an option. And two, the proximity of the stock price to the option's exercise price. In other words, how close as the stock price is to the exercise price would also influence the time value of an option. And let's explain how this works. For options that are identical in every other respect, the longer the time to expiration, the greater the time value. Alright, that point has already been made. Investors pay for time value based on uncertainty about the future stock price, in the sense that, one, if the stock price is very high and that this call option is deep in the money, the time value would be low. So what this is saying is, if you have an option written on a stock where, for example, the stock price is 100 and the exercise price of the option is, let's say, $1. 100 minus $1 is 99. So now, as you can see, this option is deep in the money. The intrinsic value is so huge that the chances that between now and when the option expires in the next few days perhaps, that there would be a turnaround that will cause the holder of the option to lose money, those chances are next to nil. And therefore, the impact of time would be very minimal, almost negligible. If that option is going to be expiring in the next, let's say, week or 2 weeks, and you have observed that the trends show that the nature of the stock is such that it's not going to go much lower, then you can expect that differences in time wouldn't amount to much in terms of the value of the option. Likewise, if the stock price is very low, the call would be in which case the call is deep out of the money, then the time value will also be low. So if on the flip side we find a stock that is almost worthless, in that it is selling for, let's say, pennies, it could be like 1 or 2 cents, right? The company is about to file for bankruptcy, or already has filed and is about to go out of business, and let's say the exercise price of the option is about $100. If you are the holder of this call, the chances that there is going to be a turnaround between now and when your option expires are so little to non-existent. And so such a deep out of money option, differences in time between the option you have and another that probably has a slightly longer time to expire or a shorter time to expire wouldn't be much, because everybody would know that there's not going to be much reason to hope for a turnaround for such a deep out of the money option. So in general, you find that uncertainty in terms of whether an option would expire in or out of the money would be highest when the stock price is near the exercise price. It is at this point we note that the time value of an option is the highest. And so if you have an option that with an exercise price of 50 and the stock price is, let's say, 50 and a half, now this option, which may still have about a week or two or a month even to expire, would definitely reflect increasingly the impact of time. So if you're comparing one option that expires in 2 weeks and another that expires in, let's say, 2 months, you would find that because the price and the stock price and the exercise price are so close together, the option that has a longer time period would be much more valuable, because you know that in the 2-month period you have a greater chance of hoping that the stock would move up in price from the $50.50 to something much greater, offering you a high intrinsic value at the end. If on the other hand, the one that would expire in the next week or two, you don't really have much time to hope that the stock price would move reasonably in the direction that you seek, which is on the upside, and therefore give you an opportunity to make money. So in summary here, time value is maximized when an option is near at the money. Time value is minimized. Its impact is at a minimum for deep in the money and deep out of the money options. And this is where we park at this time. Next stop, we're going to review issues concerning option premiums, lower boundary condition, exercise price of an option, and the effects of interest rates and volatility.